Hi there. Good day to you, and welcome to Sundaram Mutual's questionnaire number 6. Uh, as you know, following on our EMI series of webinars, we've been hosting the questionnaire because during the course of the webinar, we've not been taking questions. We've given you the YouTube live videos for you to study and then post your questions. And as usual, we have received a bunch of questions already, and we'll also be happy to take questions during the live session today. So, as is the usual practice, let me begin by quickly summarizing some of the key highlights post the last webinar so that we bring you up to date on our perspective on the economy, the markets, and the investment portfolio. So, the first news which we need to update, if you recollect, for quite some time, we've been giving this prediction that the Q1 of the financial year saw 24% negative GDP growth, and the consensus was that this would continue to be at a 9% negative for the second quarter. Now the second quarter data has come out, and the revised estimates are for a consensus around 7.5% negative of GDP. While this is still a negative and hence two consecutive quarters of negative GDP growth, that formally India is in a recession, which has happened after many, many years. The good news is that from a stock market perspective, the market always looks to expectations and performance vis-a-vis expectations. And that's where a 7.5 negative GDP is viewed as Indian economy being on the mend at a faster rate than expected. So actually the markets have celebrated this and will continue to do so because the initial forecast of a 9, which means that as early as this quarter, which is also boosted by the Diwali effect because Diwali was in November. So when the data for this quarter comes out, let us say by late January or early Feb about this quarter, it's quite possible that Indian economy would have come out of the recession and posted positive growth because the earlier expectation was a 1.7 negative growth as seen on the graph. So I think this is very good news for our economy. It means that people are resilient, that they are bouncing back, that demand is bouncing back, that there has been a pent up, absence of demand which people are now rushed in to fulfill. While this has some negative implications in the sense that this means that people are out shopping, that people are going there and going to malls and going to wherever the lockdowns have opened up. So the risk of a second wave naturally comes in with this kind of a bounce back. So I think it's a balanced view that we need to take. That I think there are 4 or 5 states which are currently threatening to have a second wave, and this has to be balanced with that because a lockdown would mean that there would be a further slowdown in terms of those states. So wait and watch, but for the present, the news is better than expected. I think that's a key takeaway that we need to keep in mind. The second is that we have greater and greater data on the second quarter earnings. And I think we have now almost for about 3,000 companies, right? And this is where the GDP growth. So if you see this graph, the concentrate on the first 2 rows. So let me refresh your memory on what these mean. Sales is the top line of the companies in the economy, right? So sales means GDP growth generally translates into sales. So you can see the negative GDP growth of 7.5 correlates with a negative sales growth of 7.9 for the market. Very, very close correlation because that's how the overall economy has been affected. The good news is on the EBITDA front. See, earnings before interest, taxes, depreciation, amortization. That's what EBITDA means. Another way to look at EBITDA is called operating profit. So here, as you can see very clearly, that there's a double-digit growth in operating profits. Now, what does this tell you? This tells you that companies in the lockdown, while they've lost sales, have been able to pass on the burden of the market to their suppliers, whether they be international, domestic, small, mid, large, they've been able to pass it on. That's why in a time when sales has dropped, they've actually widened their EBITDA margins. Like they say, never waste a crisis. So the companies in the stock market, which are, as you can think of, are the cream of the companies in India, the organized sector, so to speak. So clearly the organized sector has used this to tighten its belt, bring down its operating costs. So I think that's the good news that the companies have learned to thrive in a negative growth environment. Naturally, the profit after tax, which includes the impact of interest, right, and taxation. So, as you know, taxation has been coming down. The government had brought it down in September of the previous year. But more importantly, RBI has flushed the system with liquidity and cut the repo rate to record lows with a 115 basis points rate cut. So naturally, the better corporates in the market, who are incidentally those listed in the stock market, have been able to take advantage. So their interest costs have also come down. So you see profit after tax also growing by almost 20%, right? And clearly, the second line, just to summarize, gives you the impact excluding the banks. So as you can see, the sales number is worse when you exclude the banks. The EBITDA margin is less slightly, and the profit after tax sharply drops in terms of the growth. So clearly, the important takeaway here is banks have been less affected by the recession, by the lockdown, by the virus. What is the reason for this? Is because their NPAs haven't burgeoned because there were two moratoriums announced, and then there's a restructuring under the Kamath committee announced. So the provisioning hasn't had to go up. Second is they've got lots of cheap money, and they've got lots of money. Of the 8 lakh crores that RBI was a part of the Atmanirbhar 10.5% of GDP, 8 lakh crores was RBI's, and out of the 8 lakh crores, 5.5 lakh crores was dedicated for the banking system. The banking system got enormous amount of liquidity and lower cost. So what happens is that they have reduced parallelly the fixed deposit rates to below 5% in some cases, and their savings bank rate to below 3 and 2 to 3% levels. So their cost of funding has dramatically come down. They have not had to reduce the interest rates for the weaker borrowers. At the same time, no NPA. So their net interest margins have widened. Where they have felt some degree of pressure in the top corporates have naturally bargained, which is why you see the PAT going up. But on the plus side, the banking system has passed on only 73 basis points of the 115 basis points rate cut to existing loans. So 42 basis points of the rate cuts is being enjoyed by the banks in the form of additional net interest margins. So overall, the banking sector, in terms of the second quarter numbers, has obviously done well and has boosted the overall market, right? This was about the market. In exactly the same fashion, we will take a glimpse at how the large cap segment, the mid cap segment, and the small cap segment have performed. And here you can see the first line on sales, right? The mid caps have had a greater impact in terms of hit on sales. Small caps and large caps are somewhere in the middle. In terms of EBITDA margins, however, you can see mid caps have shown a 22% growth, and especially mid cap banks. Because when you exclude mid cap banks, that drops to 11. So in the mid caps, the banking segment has done very well in terms of operating margins. And in the small cap also, it's the banking sector which has done well in terms of operating margins. As you can see, overall small caps is 22%, but exclude banks and that drops to 6. But the two stories here, one is that every segment, large, mid or small, has been able to pass on its cost to the unorganized sector. That's number one. Number two is that the banking sector has indeed done well across the mid caps and the small caps, right? That's the second point. And when you come to profit after tax, it's roughly the same thing because the interest is a huge part of a cost of a mid cap and a small cap company, the dramatic reduction. And plus, they haven't borrowed as much because demand has not been there. So the interest costs have sharply dropped. So you can see there that there is a huge impact there. And the banking segment, again, is the one which has dominated the profit after tax. So overall takeaway is that sales has got affected by the slowdown, the minus 7.5% GDP clearly reflecting. Operating profits have widened for stock market companies, which is the reason, part of the reason stock market is celebrating and rising. And more importantly, interest cost reduction across has helped both the banks and the non-banking segment. So those are the key takeaways from an update on the earnings growth. And so now when you look at the sectoral trend in terms of the prices move, since we are talking since the last, I would draw your attention to the 1 month return. And as you can see in the 1 month return, the highest return has come from one, the banking and financial services, 1 month 19%, which as you saw the earnings justifies it. And then you come below and you see capital goods, realty, metals, right, power, oil and gas, all these cyclical sectors have actually started delivering better returns. So the first signal here is that the people who are buying, the knowledgeable buyers who buy the sectors first, are actually shifting their money to the slightly riskier parts of the market where a cyclicality comes into play. Whereas the safer elements, like if you take Nifty consumption, you take IT, technology, you take healthcare, those which have held the market with strong growth over the last 6 months are actually shown only a low single digit growth. And even within consumption is the auto sector, which again is a kind of a higher risk segment, which has shown the double digit growth. So the second message here is the recovery of the economy is already being read by the market, saying that now it's time to go more domestic economy sensitive stories, which are at the bottom end of this graph, right? As opposed to a safety play, which is largely what you do when you're uncertain about the future, right? So that's a second takeaway as I'm building the story. So naturally, in terms of the, when you look at it from a cap curve index, the first two rows talk about the large cap index, the next two rows talk about the mid cap, then you have the small cap, then you have what is called the broader market. But bear in mind that the broader market is about 80% large caps only. So here, what can you see? You can clearly see that it is a fairly even flow, right? Despite the fact that you saw that earnings of small caps and mid caps have grown faster than large caps, you're seeing that mid caps have been slightly, maybe 2 percentage points, and the 1 month return is what I'm focusing on, slightly better. And whereas the small caps and the large caps have more or less equally performed. So that means there is liquidity coming through all the channels, and despite small and mid caps showing better earnings growth in the profits, still they haven't grown that much faster. Everywhere is closely grown at the same rate in a 1 month return. To delve deep into this, you've got to look at the flows. So where is the large cap segment getting the support from? Despite the fact that the performance is not as good as mid and small cap of the earnings, it's because 1,53,000 crores is the total FII inflows from the financial year to date, which is from April to now. It's a huge amount of support that the stock market is getting from the FII segment, whereas domestic mutual funds have sold 57,000 crores worth of stocks until yesterday. So clearly, what is the reason for the mutual funds selling? Part of the reason is whatever the FIS are buying, they are selling. So the cash that comes, they have been diverting into mid and small cap to some extent. That explains the rally in the mid and small cap. Second is that mutual funds from April to now have generally faced net outflows, right? So they've also needed to sell to meet the redemptions, right? That's the second thing. The third thing is that why FII money is coming in, if you understand, then you'll understand why mutual funds have been sellers. Because if you now look at it, FI money has been essentially coming because this, for positive growth trend on the GDP growth, they are projecting onto a very strong growth in the next year. And so effectively, if you look at it, from a 477 EPS, you're going upwards of 640. So there's a huge jump in the expectation of Nifty EPS. That expectation is one reason that FIIs, whose large concentration is around the Nifty, the top 100 kind of companies, is where that's getting a support. That is the more of the predicting the future. So despite this quarter, the large caps not growing faster than the mid caps, you're seeing that the earnings expectation for next year, there is a strong growth on the Nifty. Second is relative valuation. So I draw your attention to the second graph, the left-hand side, the first graph on the left-hand side, and you can see two graphs there. Both of these graphs are the PE of India versus the PE of the world and PE of the emerging market. So the green graph there, it compares India's PE with that of the emerging markets, and the lower blue line tells you India's PE with respect to the world PE. So what you can see here, you got to look at this as a trend line. And if you look at it, what I have circled there, you can see that the green line and the blue line both have corrected sharply over the last 2 years, ever from April 2018, came to a bottom in March. And because India has historically always commanded a premium because of our superior growth rate, our structural positives, that premium had corrected by as much as 30%. And with that valuation growing and with Indian economy looking to recover, the FII going back has led to a V-shaped recovery in us, India's premium, but it's still not reached our peak level, which was in April 2018. So there's still some way to go, but the trend line has reversed. And the reason is that foreigners are willing to pay a premium when they saw a sharp correction in that premium. In fact, in the world comparison, it basically went to a discount. They said India is very attractive and they pumped in the money. So that's another reason for the FIS pumping money. That is, they are comparing India with the rest of the world. Whereas domestic mutual funds only compare India with our own historic past, right? They're not comparing the rest. So that comparison with the historic past comes here. So there are two graphs here. The left-hand side is the P ratio compared to historic India's. And we use MSCI India to give you the same index that the foreigners use, right? And there, as you can see, India's valuations, P ratio is well above its long-term average. Yes, it's still some way off from the peak that it reached in 2007, but it has already reached the previous peak here. So the MSCI India P ratio is actually quite reasonably or, higher than our long-term average in terms of valuation, right? This is what domestic mutual funds see. But FII is, as I told you, see this with respect to the rest of the world. That's number one. Number two, FIIs also are interested in the next graph, which is the right-hand side, which is called the price to book value graph. The reason I point out this is India's demand has collapsed over the last 2-3 years, right? COVID came and gave the final jump to it. So as the demand kept collapsing, the existing capacity utilization came down. So which means the stock market correction meant that the price to the book value didn't change. Book value remained the same, right? The plant, machinery, land, buildings, whatever. So the price to book value corrected well below its long-term average. So from a foreigner's perspective, on a price to book basis, India is still undervalued. And hence, they feel that the demand as it creeps up, India in profitability can rise without the burden of an interest cost taken for fresh capacity creation or a depreciation cost incurred in fresh capacity creation. This for a foreigners is looking very, very attractive. But domestic mutual funds have not fully bought into the story. Also, please remember something not on this graph vis-a-vis domestic mutual funds is that the rally has been very polarized only with 10 or 15 stocks. Obviously, domestic mutual funds cannot concentrate their portfolios to 10 or 15. So whenever there is buying taking place by the FIIs in those 10 or 15, they have been happy to sell to them because regulatory limitations, diversification limitations, and their own perspective that the Indian economy may take a little bit longer to recover, and they are not thinking about it of India versus the others. It's only about India versus our history. That gives you an explanation on that chart. Right. So as a result of this, as I said, mutual funds, while being net sellers, whatever they're selling to FIIs, they've been diverting to small caps and mid caps. So as you can see here, this long-term graph, the Sensex mid cap, small cap, and I draw your attention to bottom, the table where we have pointed out as phase 5, which correlates with the uptake. So as you can see here, from March to October, this period, when the markets have recovered post the pandemic, all the three indices have roughly gone up in a similar level, right? Now, this could be a short-term bounce back on fundamentally an economic recovery phase. So we have labeled it as a phase 5 of a recovery phase. As the data is coming out better and better, we're getting more confidence around thinking that this is real recovery in the economy. There you see that right now, the rise has been more or less equal. Whereas if I draw your attention to phase 3, which was the previous bull phase, in phase 3, large caps went up 61%, but mid caps went 192%, small caps went up 226%. If I draw your attention to phase 1, which was the previous bull phase to that, so large caps went up 559%, mid caps 900, and small caps 1400. So if a true bull phase is in the formation, you will see mid and small caps outpace large caps tremendously. That has still not yet happened. So to that extent, while there has been buying in small and mid caps slowly starting from fund managers, it is still not reflective of the kind of demand for mid and small caps which occurs when the bull phase of an economy is in place. So that first fact is being reflected here. If you compare all the three large, mid, and small cap indices with the market's previous high, which was in December 17, you can see that the P ratio of the Nifty has gone up by 0.6. But for mid cap and small cap have come down by 8.5 and 4.5. So they are way off from the previous peak, which effectively takes you to the table below, which tells you that mid cap and small cap indices are trading today at about 16% discount to the large caps. Right? So this is a very useful thing in terms of putting in place your asset allocation, right? And hence, to summarize our situation, right? The disruption of the pandemic is well behind us. The monetary and fiscal stimuli are working its way in. Certainty on the US elections is now coming with Biden win, which is positive for trade and for a continued stimulus. Agriculture and rural India have remained strong and relatively unaffected by the pandemic, and a lot of other improving price realizations, MSP, rising rural spends, and agri is adding support to rural India. RBI has been very supportive and preemptive, and its liquidity engine, coupled with the resolution framework, are set to greatly aid the ongoing recovery. And the government has also been redirecting its fiscal funds in the form of packages to put consumption, and that recovery itself will take care for the banking system of the stress buildup, right? And India's infections have clearly peaked, and hence any vaccine approval will work to hedge any downside risk of another spike for India, right? And otherwise, the environment is very supportive in terms of low corporate tax rates, low interest rates, ample liquidity, reforms being rekindled, ease of doing business being improved, government tactically doing production-linked incentive (PLI) schemes to support foreign manufacturing coming to India, and the world looking to have a plan B for a China dependency on their manufacturing, which is what we call the China plus one shift. All will be supportive for FDI flows to flow into in, and with that, overall emerging market Asia is set to attract a sizable part of the global quantitative easing liquidity on the back of a better COVID handling, low debt ratios here, and the low crude prices, which are a key positive factor, right? So from a portfolio of Sundaram, the way we summarize and what we've done now is to tell you that we are positioned for a domestic growth recovery. So we are increasing exposure to quality financials within which well-run large private banks and good quality NBFCs feature, consumer discretionary, the higher value items, building materials which are supporting the infrastructure push, and the auto sector. So global recovery, which is also another story, we will look to play them through agrochem, specialty chemicals, auto ancillaries, and IT. And the reason we are constructive IT is because we see their balance sheets are very good, very little borrowing, potential for cost savings are there, along with the initiatives in the digital and the cloud, which would be drivers, right? We do keep a good position in defensives like FMG, pharma, and telecom in select stocks because any risk of second wave, any other thing, plus FII money tends to favor these sectors. We do hold positions on that, right? But overall, we have moved to a very sectoral neutral vis-a-vis the benchmark, right? So that we give ourselves enough room to play the cap curves and companies within sectors, right? So that's where we will, like I said, the key risk still remains an India second wave if it happens. And from that point of view, approach is to capture reasonably valued stocks with a growth-oriented focus, right? So thank you for that. I gave you a quick update. Let me move on to the questions that we have already received, right? So the first thing I got as a question was the impact of the second wave on large caps. Now, the impact of the second wave on the large caps can be looked at on two perspectives, right? There's a second wave likely in India, if so, or the second wave already happening in the Europe and the US. So I think while medically it's not good news, the fact is that it also means that quantitative easing and low interest rates are likely to continue for longer to continue to support because they may delay world recovery a bit, but the more world recovery gets delayed, the more quantitative easing is likely to remain. And hence, for Indian large caps, I think it's actually a positive, right? Because the safety element, which is where large caps also largely play, has got a greater weightage. So I would say impact on the second wave would actually increase demand for large caps from FIIs in India, right? Second question, which is also the more generic ones on why our stock market going up now. I think I've answered that in the course of these 15, 20 minutes. But just to summarize, the reason they are going up now is A, foreign liquidity continues to favor India because compared to other alternatives, India is attractive. Two, India's bad news happened early, as a 25% in the first quarter, was driven by our own severe lockdown, which made it that our bounce back would be fairly good. And that's why the bounce back actually has beaten market expectations at only 7.5 versus an expected 9. The third thing here is the fact is that by and large, India seems to have controlled the pandemic, and only 4 states are. The risk of a second wave, while it does exist, is much less in India because more or less most of the states have done a good job in controlling. That's why the stock markets are going up now. And I should not omit the fact that Biden's coming to power is a positive for world trade, and hence world economic recovery can be expected to be fast tracked because of that. So these are the reasons. Somebody asked me, when will mid and small caps do well? Well, they've started to do well. But for a sustained growth, the economic downturn, the negative GDP has to convert to positive. One. Second is, it's not just about the fact that GDP turns positive. It's got to be a demand-driven growth in GDP so that capacity utilization goes up and new capacity creation starts getting announced and implemented. That's when mid and small caps, which are heavily linked to the domestic economic growth. So consumption is one leg of the Indian economy, but capital expansion is another leg. Both the legs need to grow in tandem for the mid and small caps to really post a strong earnings growth and the market to then give them special favors in terms of taking up their prices. So I would say that wait for this V-shaped recovery to pan out. Give it maybe 6 months, 9 months, a year at max from today is what I anticipate. Should we start selling pharma now is the next question. Well, uh, it depends on when you bought pharma, right? You see, if you've always been a holder of pharma, it's good to book profits because pharma's had a golden run because of this. But now that the vaccine news is out in the public domain, right? Now it's going to be very company specific to see which company gets the order to manufacture. And as you know, a couple of those vaccines are not India friendly in the sense they need minus 80-degree storage, cold storage, which we don't have. So to that extent, that portion of the manufacturing of that vaccine is likely to go to some of our other competitor countries. Some of it will come to India, and there are vaccines which are India suitable too. So while the selective pharma companies will benefit, whether there's an overall pharma, everything benefiting, I think that day is coming close to an end. And pharma will now begin to trade on its own long-term sustainable growth option and not necessarily pandemic related, right? So if you've never had pharma, you miss the pharma boat, it's a good time to keep some pharma. But if you already participated in the joyride that's happened, I would say it's time to pare down the pharma in your portfolio and add on other domestic economy sensitive stocks. So that's my recommendation on pharma. Somebody asked me, how badly will commercial real estate be affected with the companies implementing work from anywhere policies? See, there's a lot of hype here. For the reason that, yes, in the immediate post-pandemic, when everybody was scared of travel and all of that, a lot of companies did initiate almost 100% work from home. And hence, commercial real estate prices by all companies got renegotiated down, at least 10, 15, 20%, the rentals came down. Now, in the future, right, there are some set of companies, which what you apprehend, who have permanently reset their business models to say, I think I find working from home was great, right? And I'd like to continue. So there are companies like Twitter, like MasterCard, like a lot of companies have completely shifted to work from home, some which have given the option to their employees. So definitely all of this will mean that there will be some degree of consolidation of real estate space. I wouldn't need that much more space. So what, however, I see is that, so the expansion of companies would now go more from this line rather than, so new demand for new real estate is definitely going to get impacted by this. But how big is this component of the overall real estate market is the key question, because ultimately when life comes back to normal, right, I think a lot of companies, while they readjust to the new reality for the time being, I don't think will permanently shift to that. So I think there will be a balance. Definitely there will be a slower than expected growth rate, but I don't think that the real estate, commercial real estate industry is going to collapse or anything like that. I think there is enough room from an India growth story perspective for there to be demand for real estate. yes, there will be correction in the prices and correction in this, and there will be some reallocation. Some builders who are sitting with empty land pockets would probably now prefer to build a residential real estate complex rather than a commercial complex. So there will be some demand and supply trying to come to closer to each other. So that's the way we read the situation, right? Another question that came in says, have IT companies run up or can we continue to have significant exposure to them? I think IT is one sector, unlike in pharma, where I said you can pair some positions, you should continue to hold IT because the changes that's happened to IT because of the COVID are more permanent in nature. The slide which I currently have on screen, you can see I've said, no, talked about digital, cloud, right? Those kind of a things. So those are all a fundamental reset. And I think more and more dependence on IT and outsourced IT will be the norm in the world. And I think IT as a sector from India, given the quality of our labor and the quantity of our labor, will continue to be a decently growing industry. And I would recommend that you continue to hold your positions on the IT sector. Right? I think that there is good value there because there's always going to be a demand for safety and visible growth, which is what the IT is very, very clearly positioned to deliver. Right? Negative questions which have been coming are like, what do you think at current levels one should stay invested or book profit or gradually increase investment? A small cap is good to invest from 3 to 5 years, is what they're asking. So I think that, see, I have a fundamental view that if you're a trader, you can do any of these. But if you're an investor, then you always have to do goal-based investing. And if your goals are close to reality, you have to book profits. One. Second is that when you now look at it as booking profits, I don't think that the Indian stock market is anywhere near the kind of full potential that it can deliver wealth creation. So if you have medium-term goals, this is the right time to enter the stock market and to a broader market. I would say in the last rally, only 10, 15 stocks have kind of carried the whole market up. But that's not the sustainable story. The sustainable story is an Indian economic story which translates to Indian broader market. So I would say it's a good time to reallocate your portfolio among large, mid, and small, and within sectorals also across a broader range of sectors. So I would say if you had a very concentrated large cap portfolio, you can pair those profits and shift it into multi-cap, flexi-cap, or even mid and small cap funds to some extent. So I think that that would be the story, that in a broader market, the potential for inflation beating returns is quite good, and you should definitely stay invested. That's my answer. The other question is, small cap is good to invest for 3 to 5 years. Absolutely. I think it's a fantastic time to invest in small caps because they borne the brunt of the damage. And the industrial sector is a free part. Recently, pharma has become the number one holding of the small cap index, but that's because of the rise in the price, right? I think that will tend to stabilize. And industrials, building materials, all of these are the dominant sectors in small caps. And I think the next 3 to 5 years is going to be the Indian economic growth story, and small caps are poised. So if you have that 3 to 5 year outlook, I would say all the best. You have a very good time frame, and small caps should be a significant part of your portfolio from that time frame, right? So somebody else asked me, why are DIS continuously selling? I think I addressed it in my 15-minute bit. Let me repeat it here again. Because DIIs, for them, they have to maintain diversified portfolios. They saw the concentrated portfolios rising because FIs were interested only in selective stocks. They couldn't take that kind of a holding, so they had to sell. Second is they face redemption pressure from investors from right from April to now, and so they have had to sell. Third, like I said, is that they are waiting to see the economic recovery. So they're sitting on cash so that they can deploy it in that sector, which actually will show the maximum growth. So I think the next couple of quarters is when that clarity will come. There's a union budget to happen. So they will gradually deploy during that period. That's broadly the reason that DIs have been sellers, right? Then somebody asked me, should we exit gold now, right? See, if you entered gold to outsized part of your portfolio and have made good money, you should exit a significant portion of that. But don't make it zero. Because gold is your ultimate plan B. It is your fallback. If suddenly a black swan event like a COVID crisis or some other crisis happens, something, right? Unpredictability is there in the stock market and in life. Gold is a good hedge. So I would recommend that a 10 to 15% allocation to gold as for a moderately risk investor is something you should always hold. If you had taken up that gold position to higher position, definitely it's a good time to book profits, because as world economy and Indian economy recovers, gold will lose its charm because it doesn't have an earnings to support its price rise. It's the absence of earnings. It is high inflation, hyperinflation. It is the dollar being under pressure. These are the factors which push gold up, right? They need negatives in other parts of the world for gold to be positive. But when the world is turning positive, naturally that need for a fallback of gold comes down. So then as gold, people start selling gold, their prices, it's a vicious cycle. So there will be some degree of price correction happening over a period of time in gold. But at the same time, don't reduce it completely to zero. So 10 to 15% allocation is gold, I think is a sensible thing to keep in your overall portfolio, right? Somebody asked me, will home loan rates come down further? I think so. I think so, because as I said some time back, I don't think banks have yet passed on the full cost of this. And when banks get the pressure to lend, there will be competition among them. And I think that they have been hesitant now because of the pandemic and recovery. Already good quality borrowers are getting interest rates below 7% from certain institutions. So I think that there is still another 50 basis points correction that can happen in home loan sector over the next 12 months. Only after that will you see a rise happening in home loan rates. So I think there is still a little bit of juice left to get rid of to boost demand, because good quality borrowers are going to be in demand and they can negotiate a good price, which is what will happen over the next year, right? Somebody asked me, when can we expect infra companies to start moving? So I think that infra, that is your road building projects, airport projects, all of that will take time to happen, because first in part of the infra which will benefit will be the suppliers to infrastructure, capital goods suppliers, cement, building materials, because uh, the economy is still quite far from domestic players investing in capex. So for infra to happen, somebody's got to invest in capex. There are three big players who invest in capex, right? Domestic companies, governments and PSUs, and FDI, who foreigners coming and setting up companies. Government has opened the door for FDI, a lot of push, China plus one is happening. So that's likely to happen over the next 12 months. Let's take it. Government, in the budget, you'll get a clue as to how much wiggle room government has to give a strong push to infrastructure. They have this 100 lakh crore big infrastructure plan. Honestly, because of COVID, that plan has gone on a back seat. Now, post-COVID, as we recover, GST collections have gone up over a lakh crores again. So that story, right, has to really develop, and then the budget can give you a good clue as to is government next year going to give a big thrust to infrastructure, right? So that perspective has to be kept in mind. So you just wait for the budget and the announcements, you'll get a sense. But the third player here, the domestic private sector, they are quite a long way off from capacity increase, because they already increased capacity quite a few years ago, saw some rise in demand up to 2017, 18, and then the demand started going down and the COVID came in further. So capacity utilization has collapsed. So everybody has got enough capacity to produce as much as demand they can see for the next year or 2 years. It's only a 3 year later story that they will need, and so they will time their capacity expansion only when you see the consumption and the demand for their products steadily going up. So you've got to be patient, and that's going to be the last leg of the cycle, because PSUs and government can still act ahead of time because they want to use the capex as an economy multiplier, right? So there, even if the economic logic or the demand doesn't make sense, you can find the government and the PSUs stepping in and giving a boost. So first is FDI, then government, then third is domestic private. So infra will really start moving when all of this place, this is the supplies to infra. For the infra it will do, the government has to give a big thrust in terms of the road projects and railways and everything else, which, as I said, budget will give you a clue as to whether it's going to be earlier or later. I hope that answered your question. I think we have completely covered the questions that we've received. Thank you all very much for your patient listening. This video will be up on YouTube and all of that for you to see at your leisure. look forward to meeting with all of you in our next webinar on the EMI Wisecast series, right, during the month of December. Thank you and all the very best. Please do safe through the